Hi, it's Ben Craig from IG Wealth Management with another webcast installment. I hope everyone's staying safe and healthy. Canada's charities support millions of people domestically and around the world. What sometimes gets lost is, during challenging economic times like these, things are particularly tough for small charities. So I thought it would be timely to pass along some ideas to help facilitate giving, and I hope you find the information useful. Today, we're going to talk about charitable giving as a strategic part of your financial plan. We'll start with an overview, then we'll talk about your options and some key tax considerations, then we'll finish with a couple of case studies. A successful plan starts with having a trusted partner, and that's what you get with IG Wealth Management. We've been providing comprehensive financial plans to Canadians for 91 years. We serve over 1 million families in Canada with roughly $89 billion in assets under management. Comprehensive financial planning, including philanthropy and charitable giving, is at the heart of our company culture. It's the key ingredient of how we help Canadians reach a successful retirement. Our parent company, Power Financial Corporation, is one of the world's largest and most well-respected financial firms. Power Financial has invested in traditional insurance and wealth management companies within Canada, such as on the insurance side, Great-West Life, London Life, and Canada Life, and on the investment side, Mackenzie Investments. Power Corporation has also extended its reach into innovative new technology solutions with strategic investments in companies in Canada and the US, such as Wealthsimple and Personal Capital, and in China with fund management company China AMC, which serves the rapidly growing Chinese market. Through this strong network of diverse relationships in the financial services industry, we provide confidence that we can meet your needs today and in the future, as new technology and innovations make it easier to provide you with ongoing and ready access to your financial plan. Here at home, IG Wealth Management is one of the largest wealth managers in Canada and is in the top 10 wealth managers in the world. We recognize that no one company has a monopoly on the best investment ideas. That's why we complement our internal expertise with our external partnerships. Our affiliations with partner companies, and you can see some of the names listed here, means we can leverage their intellectual capital and expertise and ensure our clients can access opportunities around the world. As you start to plan for your retirement, consolidating your holdings can help simplify your planning and maximize your usage of the appropriate income tools. Because we provide solutions from leading industry providers, we eliminate any concern that consolidating your investments will reduce your investment opportunities. IG Wealth Management believes in the strategy of leading as a company, being a strong corporate citizen, and giving back. We support more than 1,700 charities across Canada, helping to raise more than $9.7 million just over the last 12 months. Our ultimate goal is to help you achieve financial well-being. To do so, we look at the 6 major areas of your financial affairs: managing your business success, managing your cash flow efficiently, and of course, sharing your wealth. Again, depending on the complexity of your situation, some of these areas might have impact on others. This is the reason why we need to have a synchronized approach in order to maximize your financial plan. Today, we're going to focus on charitable giving specifically and explore key tax scenarios to help you make the most of your giving and leaving a legacy. You've worked hard to get where you are today, and you may be thinking about the best approach to share your wealth. You give because you're a giving person. Although giving to charity should be planned like all of your other finances to get the most out of your giving. A carefully constructed plan helps create a legacy of giving that expresses your values and the causes you care about. Don't wait to donate until your death. Instead, give during your lifetime to maximize tax benefits, and so your giving already begins to have an impact on others. Making charitable decisions now also kickstarts the discussion for families about how money will be transferred between generations. Children can sit on the boards of private foundations, and they can be involved in discussions about what causes it should support. As we'll discuss in further detail, there are several advantages to planning carefully in order to maximize the benefits of your charitable giving, especially when it comes to tax efficiency. Think long-term about the implications for your overall estate's tax liability and your family's well-being. Evaluate when to donate, what to donate, and how. Before we get into the various methods of planned giving, we should provide some background on the tax implications. The federal government has supported the objectives of increasing bequests and other estate gifts by implementing legislation designed to encourage more and large gifts to charities from individual Canadians. These incentives make planned gifts even more attractive to potential donors. The maximum amount of charitable donations you can claim is 75% of your net income. Where a sizable gift has been made, causing these limits to be exceeded, there is a 5-year carry-forward provision, which should allow for the entire donation to be claimed over 5 years if necessary. The Income Tax Act also provides that donating publicly listed securities directly to a registered charity is more tax advantageous since you do not have to report any of the portion of the resulting capital gain. Donating corporately also has significant tax advantages. Capital gains are eliminated for both personal and corporate gifts of public securities when the gift is made in kind. For today's purposes, we'll focus more on personal donations. In this example, tax savings are 25% on the first $200 of the donation when combining federal and provincial donation tax credits. Tax credits will vary by province. Donations in excess of $200 will save 46% in our example. However, this is increased to 50% for donations to the extent that you have income in the highest tax bracket. Let's have a look at your charitable giving plan options. The simplest option of all is to leave a charity a bequest in your will. It could be a sum of money or a gift in kind, such as artwork, securities, or real estate. Depending on the size and nature of your gift, the tax credits could eliminate all of the income tax on your final tax return, and possibly the return for the immediate preceding year as well. Selling securities in order to raise cash to make a charitable gift can trigger a capital gain, resulting in 50% of the gain being included in your income. However, the Income Tax Act provides that donating a publicly listed security directly to a registered charity is more tax advantageous since you do not have to report any portion of the resulting capital gain. That is, the inclusion rate would be nil rather than 50%. Upon receiving your gift in kind, the charity would issue you a tax receipt for the fair market value of the investment. Publicly listed securities include stocks, bonds, units of a mutual fund trust, shares of a mutual fund corporation, and a segregated fund. When you donate a life insurance policy to your favorite charity, you ensure that the charity receives the total insurance proceeds upon your death. If you own a life insurance policy, RRSP, RIF, or TFSA, and designate the charity as the beneficiary, the premiums or deposits paid will not qualify as a gift during your lifetime. However, if the proceeds upon your death from a life insurance policy, RRSP, RIF, or TFSA, are paid directly or indirectly to a charity as beneficiary, the charity will be able to issue a donation receipt for the funds it receives. Finally, establishing a private foundation does more than ensure your generosity will live on. It can also permanently associate your name or your family's name with causes you've chosen. The rules for registering private foundations are quite complex, and a private foundation requires considerable administration, which can be very expensive and time-consuming. Before you give, consider what you'll give. Gifts of stocks or mutual funds in kind allow you to avoid capital gains tax on the gift, but you still get a full charitable credit for the fair market value of the gift. Here's an example of donating in kind versus cash. In our example, a donation of $25,000 cash would result in a tax credit worth $11,500. Donating in kind versus cash provides a net additional benefit given the elimination of capital gains. These additional tax savings would be received in addition to the $11,500 of donation tax credits. The accrued unrealized capital gain on $25,000 of securities with a $5,000 adjusted cost base equals $20,000 gross capital gain. The inclusion rate is 50%, which is $10,000 capital gain. Assuming the individual is in a 40% marginal tax bracket, then the $4,000 capital gains can be eliminated for a total tax savings of $15,500. Donating insurance policies gives the potential to donate much more than the dollars you actually put in. There are two ways to donate. 1. Make the charity the beneficiary of the policy. This gives you a large, one-time charitable donation equal to the value of the death benefit of the policy. 2. Make the charity the owner and the beneficiary of the policy you pay for. This gives you an annual charitable donation equal to the premiums you pay. Let's look at a couple of case studies. Jane and Bill have $100,000 to invest. They want to leave money for their church, but they also want to leave money for their children. What are some of the ways they could go about this? Suppose Jane and Bill invest $100,000 for 5 years in an IG Series T corporate class fund. These shares are designed to provide Jane and Bill with $500 monthly cash flow, comprised entirely of return of capital at 6%. Jane and Bill would not pay tax on this cash flow as it is return of their principal. However, the adjusted cost base of the investment would decrease by $500 each month. After 5 years, the ACB would have decreased to $70,000. If Jane and Bill redeem their shares at this time, they would realize a capital gain of $30,000. Now let's make two assumptions. We're going to make Jane and Bill's favorite charity the beneficiary of the corporate class investment. We're going to utilize the $6,000 annual payout toward a $150,000 life insurance policy, naming Bill and Jane's children as beneficiaries. Now let's look 15 years into the future. On death, Bill and Jane's favorite charity would receive a $100,000 gift in kind. The adjusted cost base is $10,000, but there's no capital gains on in-kind donations, so $22,000 in capital gains tax has been eliminated. The children receive a $200,000 inheritance made up of the $150,000 life insurance policy and $50,000 that would otherwise have been used to pay tax. Alternatively, Bill and Jane could have invested the $100,000 at 6% over the 15 years. The bequest to their children would have been $21,000 less with no charitable donation. So that concludes my presentation today on charitable giving. Clearly, there are many variables pertaining to your personal financial situation, but I hope I provided some guidance as it relates to this important component of your financial plan. Finally, I wanted to remind you that when you work with IG Wealth Management, you're working with a team. We bring a group of specialists to the table to serve your financial needs, from Olga and Scott, our insurance specialists, to Bob, our wealth planning specialists, to Patty in mortgages and lending. And if we can't answer your questions, just a phone call or email away in Winnipeg. We have some of the best minds in the business when it comes to tax and estate planning. Feel free to call or email for more information, and don't forget to subscribe to my YouTube channel below. Thank you for your attention today. Be safe.